If someone offered you a guaranteed, risk-free 21% annual return on your money, you would call it the opportunity of a lifetime. So why are you paying that rate to someone else instead of collecting it yourself? That question is not rhetorical. It is arithmetic. And once you see it clearly, you cannot unsee it. This content is for educational purposes only. It is not financial advice. If this channel has sharpened your thinking about money before, consider anchoring that commitment by subscribing. Financial clarity compounds, just like capital does. And when you drop your core investment philosophy in the comments, you sharpen not just your own thinking, but the thinking of every serious person in this community. Warren Buffett does not mince words about credit card debt. At the 2020 Berkshire Hathaway annual meeting, he said it plainly. If he personally owed money at an 18% interest rate, there was exactly one investment he would make. He would pay it off immediately.
No stock pick, no index fund, no real estate deal. Just one move: eliminate the debt. Because in his judgment, no legitimate market instrument can reliably guarantee a return that matches what the credit card is already costing you. In 2023, Buffett extended that verdict. He said that a consumer paying 12%, 14% or more on a credit card is essentially claiming they can beat those returns in the open market. He called it economic absurdity for the vast majority of everyday investors. He went further still, telling students at the University of Nebraska that if he had borrowed money at 18% or 20%, he would inevitably have ended up bankrupt. This is not a man known for exaggeration. Now consider this. 99% of Warren Buffett's net worth was built after he turned 65. Not before, after. That figure is not a footnote. It is the entire argument for compound interest working in your favor across roughly 75 years of continuous reinvestment.
The same mathematical force that built one of history's greatest fortunes is active in your financial life right now. The question is only which direction it is pointed. Here is how a credit card actually works. The bank takes your annual percentage rate and divides it by 365. That produces a microscopic daily rate. Then every single morning, the bank charges that rate against your full outstanding balance. On day 2, the interest from day 1 has already joined the principal. The bank now charges interest on that slightly larger number. On day 3, it charges interest on an even larger number. This is not a monthly process. It runs every day, without interruption, without negotiation, and without mercy. This mechanism has a name. It is called daily compounding, and the formula behind it is precise. A equals P multiplied by the quantity 1 plus R divided by N, raised to the power of N times T. Every variable in that formula is working against you when you carry a balance. What does that look like in practice? The Federal Reserve publishes these numbers. As of February 2026, the average APR on all credit card accounts at U.S. commercial banks was 21.00%. For accounts that actually carried a balance, meaning accounts where people did not pay in full, the average was 21.52%. Those are averages. Airline rewards cards average 24.03% APR. Cashback cards average 23.81%, and the range across all products runs from 12.20% at the low end all the way to 34.52% at the extreme. If you carry a balance on a travel card, you are not earning points. You are paying for the illusion of them. Stop here for a moment. The historical average annual return of the U.S. stock market is approximately 10% per year. That is the number investors spend lifetimes trying to capture, patiently, across decades, through market cycles and recessions. Your credit card charges more than twice that.
Every year, every day. And in other parts of the world, the numbers are harder to look at. In Ukraine, the real annual percentage rate on Privatbank's standard credit card reaches 51.09%. That is not a typo. It is the documented cost printed in the loan agreement. Monobank's Black Card sits at 44.43% real APR under normal conditions. Miss a single payment and the bank doubles the rate to 6.2% per month. And for payday-style credit products embedded inside banking apps, the real annual rate reaches 197.46%, nearly 200% per year. There is a phrase that cuts to the center of all of this. Compound interest is the eighth wonder of the world. He who understands it, earns it. He who does not.
It is what 75 years of uninterrupted compounding actually looks like on a balance sheet. When that same exponential curve runs inside a credit card balance, it does not build wealth. It transfers wealth. Specifically, it transfers your future income, the hours you have not yet worked, the raises you have not yet earned, directly to the bank, at a rate the bank set, on terms the bank wrote. Compound interest is not neutral. It is a force multiplier. Point it toward your assets, and it builds independence. Allow it to run against your liabilities, and it guarantees that someone else's wealth is constructed from your labor. There is no middle position. And here is what most people never calculate. The minimum payment on that balance was not designed to help you escape. It was designed to keep you exactly where you are, paying every month while the principal barely moves. The trap was built into the product from the beginning. You made your minimum payment last month.
On time, no late fee, no penalty. The bank sent you nothing but silence, and that silence cost you everything. Here is what actually happened inside that transaction. You owed $5,000 at a 21% annual rate. Your minimum payment was $100. $87.50 of that went straight to the bank as interest. $12.50 reduced what you actually owe. Before we go further, everything in this video is for educational purposes only. It is not financial advice. Now, let's continue. Because the arithmetic we are about to walk through is something every person carrying a balance needs to see at least once. $12.50. That is your progress for the month. That is what $100 of your labor purchased in the direction of freedom. This is not an accident. It is arithmetic. And the arithmetic was designed before you ever applied for the card.
The minimum payment exists because banks discovered this. A customer who pays the minimum stays in debt. A customer who stays in debt keeps paying interest. A customer who keeps paying interest is, from the bank's perspective, the ideal customer. Now, scale the numbers. $50,000 in credit card debt, paying the standard 3% minimum each month. You will make payments for decades. When the final payment clears, you will have paid $148,886 to eliminate a $50,000 balance, nearly 3 times what you borrowed. The bank collects $98,000 that you earned and will never see again. The pattern holds at every level. $10,000 in debt costs you $28,887 total. $25,000 costs $73,886. The ratio stays brutal.
You always pay close to 3 times the original debt. And these figures assume the United States average rate, 21%. Now, consider what this looks like for someone carrying a monobank Black Card in Ukraine at a real annual rate of 44%, or a Privatbank product at 51%, or a payday-style credit line embedded in a banking app at 197% annually. That last number means this. Borrow the equivalent of a month's salary in January. Make only minimum payments. By December, you owe 2 months' salary, and you have bought nothing new. The debt simply fed on itself while you worked. Miss a single payment at Monobank, and the penalty rate doubles to 6.2% per month. One missed payment. That is the margin between difficult and catastrophic. But here is what should unsettle you most, and this applies whether your rate is 21% or 51%.
The stock market has historically returned approximately 10% per year over long periods. Your credit card debt is costing you more than double that. Every month you carry a balance, you are running a guaranteed negative return on that capital. There is no portfolio strategy on earth that closes this gap. Warren Buffett has been direct on exactly this point. Attempting to earn 10% in equities while servicing a credit card balance at 20 or 30% is not investing. It is subsidizing the bank while calling yourself an investor. So why do intelligent people stay on this treadmill? The answer is not ignorance. The answer is architecture. The financial industry spent billions engineering a specific outcome. They wanted spending to stop feeling like loss. They called the solution frictionless payments. Tap, click, done. The physical act of handing over cash, the moment your hand feels lighter, that sensation was the natural governor on consumption.
Digital payments eliminated it entirely. When spending does not feel like spending, the natural break disappears. Retail therapy, emotional purchasing, the dopamine of something new. These are not character flaws. They are predictable responses to an environment deliberately constructed to trigger them. The grace period reinforces this. 30 days of zero interest feels like free money. The cashback reward feels like the bank is working for you. These features are real. They are also the mechanism that keeps you engaged with a product that, the moment you carry a balance, extracts wealth from you at a rate no investment can match. So ask yourself an honest question, not a comfortable one. How much have you paid in credit card interest over the last 3 years? Not principal, interest alone. Money that built nothing, money that bought nothing. Money that simply transferred from your account to theirs because of a balance you carried from 1 month to the next.
That number, whatever it is, represents money that will never grow for you. It is gone. It cannot be invested. It cannot compound. It was simply rented to you at a price that guaranteed their profit and your loss. Here is the reframe that changes everything. The minimum payment feels manageable. That feeling is the trap. Call it what it is, a slow, reliable transfer of your net worth to a financial institution. Not a crisis, not a catastrophe you can see, just a quiet mechanism running every single month, moving wealth in one direction. Buffett has said it plainly. Excitement and costs are the investor's two greatest enemies. Not market crashes, not economic cycles. The enemy is internal. The willingness to accept a slow bleed because it does not look like bleeding. Paying off a 21% credit card balance is not merely eliminating a debt. It is earning a guaranteed 21% return on that capital. Immediate, certain, and risk-free in terms of avoided cost. There is no publicly available investment that offers that with certainty. None. Every dollar you send to a bank in interest is a dollar that cannot compound for 40 years on your behalf. That math runs in only one direction right now. The next question is how to reverse it permanently, and what to do with every dollar you reclaim once the debt is gone. You now understand the trap. You've seen the math. The question is no longer, why am I struggling? The question is, what do you do, in exact sequence, starting today. Action 1 is physical, not psychological, not motivational, physical. You eliminate the mechanism that triggers the spending before your brain has time to object. Cut the card. Not metaphorically, literally. Remove saved payment details from every app, every browser, every one-click checkout. Friction is your ally now.
Dave Ramsey built an entire system around this principle. He calls it the envelope system. For every discretionary spending category, groceries, dining, entertainment, you load a physical cash envelope with your budgeted amount for the month. When the envelope is empty, the spending stops. Not, you should probably stop. It stops. The cash is gone. There is nothing left to spend. The pain of paying, the same pain credit cards were engineered to eliminate, is restored. That pain is not your enemy. It is your most honest financial advisor. Every time you feel it, it is telling you something true about the cost of a decision. Credit cards silenced that advisor. The envelope gives it back its voice. If you needed cash in hand to buy it, would you still buy it? For most impulse purchases, the honest answer is no. That single question, asked before every transaction, is worth more than any budgeting app ever built. Action 2 is mathematical. You list every debt you carry. You rank them by interest rate, highest to lowest. You pay the minimum on everything else. Every extra dollar goes to the highest rate debt first. This is the debt avalanche. It is mathematically optimal. It minimizes the total interest you pay across every account. It is the fastest path, measured in dollars, to debt freedom. But there is a second path. The debt snowball. You list the same debts, and you rank them by balance, smallest to largest. You eliminate the smallest balance first, entirely, before moving to the next. The first account you close creates a psychological event, a concrete win. Dave Ramsey observed decades of clients complete their debt payoff plans only after experiencing that first elimination. The momentum from a small victory sustained the discipline for every larger one that followed. The avalanche saves more money. The snowball saves more people. The right method is the one you will actually complete.
Choose one. Commit to it. Do not revisit the choice every month. Execute. The question of when to start investing has a precise answer, and most people ask it too early, before the conditions that make investing rational actually exist. You invest after two things are true. First, high-rate debt is eliminated. Second, you hold a cash buffer of 3 to 6 months of essential expenses in liquid savings. That buffer is not an investment. It is insurance against the single most common reason people re-enter credit card debt: an unexpected expense with no liquid reserve. Without it, the first car repair sends you back to the beginning. Once the debt is gone and the buffer exists, Action 3 begins. Every dollar you were sending to the bank, the minimum payments, the interest charges, the fees, stops going to them. It starts going to work for you. This is where index funds enter the equation. Vanguard's VOO, an S&P 500 ETF, carries an expense ratio of 0.03%. The average actively managed fund charges between 1% and 2% per year. That gap, compounded over decades, is not a footnote. It is the entire story. VOO became the first ETF in history to surpass $1 trillion in assets under management. Since 2022, it has grown fourfold. The global ETF industry now holds $21.9 trillion. This is not a niche instrument. This is where the world's capital has migrated. The data on active management is unambiguous. Over a 10-year horizon,
83% of index funds outperform their actively managed peers. Vanguard's passive funds carry costs 76% lower than the industry average. Lower costs mean more of every return stays with you, every single year, without exception. Consider what that means in practice. A 1% annual fee on a $100,000 portfolio costs you roughly $30,000 over 20 years in foregone compounding. A 0.03% fee costs you under $1,000. The fund manager's fee is not small. It is a second debt you carry in retirement.
Buffett's rule number 1: never lose money. Rule number 2: never forget rule number 1. Paying 21% interest while attempting to invest is not investing. It is losing money at high speed while calling it something else. Index funds at 0.03% after debt is eliminated, that is finally following the rule. Compound interest is not neutral. It is either the force that builds your independence or the mechanism that guarantees someone else's wealth is built on your labor. There is no middle ground. This content is for educational purposes only and does not constitute financial advice.